It's been another interesting quarter for markets with sort of quite divergent returns across both asset classes, regions and sectors. The US equity markets really led the way, and that's been driven by sort of very buoyant sentiment to sort of how the US is going in terms of its growth, developments in unemployment, and sort of where things may go from here. At the other end of the scale, emerging markets have really sort of been hit by negative sentiment, particularly coming from sort of a strong US dollar. And that's really flowed through into returns for not just EM equities, but bonds and currencies as well. At the other end of the spectrum, we've had Japan. Japan had a fairly weak start to the year, but sort of in the last quarter, returns have been much stronger there. At a sector level, we've seen a lot of divergence across the different sectors. Leading the way has been energy on the back of a rising oil price, while healthcare has done particularly well as well, up over 15% in the last 3 months. At the more defensive end of the spectrum, bonds have had a particularly interesting quarter. I've already mentioned sort of emerging market bonds having a tougher time of it, but US bonds, with the US Fed continuing to raise interest rates, they've had a weaker time of it as well. But closer to home, sort of Australian bonds have done much better as the Australian Central Bank has decided to keep rates on hold, at least for the time being. Despite the divergence in returns that we've seen from asset classes and regional markets, the portfolios have generally had a pretty good quarter. And that's really sort of come down to good stock selection across the portfolio. The good quarter has also come on the back of a weaker quarter in Q2, so that's been good to see. Returns have really sort of come from stock selection in emerging markets. Emerging markets generally have sort of had a pretty sort of weak performance relative to other markets, but we've been able to pick the eyes out of the market and deliver some good returns there. Other returns have come from our investments in US healthcare as well as European energy. Both those portfolios have done particularly well and delivered good returns to the portfolios. Looking forward, we think the portfolios are in good shape to continue delivering on their objectives. We look at the last couple of quarters and see where performance has come from, and we don't think it's going to be those same sectors or regions which will deliver performance going forward. We actually think it's going to be some of the sectors or regions which have been out of favour which are going to benefit the portfolios. So in that regard, we continue to hold larger exposures to emerging markets, both in terms of the equity markets and the bond markets. We also think that there'll be some good returns coming from Europe. Europe's had a weaker quarter the last quarter, but we think looking forward the fundamentals and valuations there are much more attractive relative to what we see, particularly in the US. Secondly, we think markets might be more difficult or have a more tougher time of it. And on that basis, we think sort of that may cause some opportunities for us to use the higher levels of cash that we have in the portfolios, and being able to deploy that cash into better opportunities will benefit returns looking forward.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.